This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I'm your host. I have my good friend, Peter Offringa, with us today. Peter writes a blog post called Software Stack Investing, which I've been reading for the past couple of years. He's also been a speaker at some of my conferences, so we've stayed in touch. Peter, how are you?
Doing well. Yeah.
So you are you're a cloud guru, software guru. And I mean, I know we follow a lot of the same companies. You know the companies a hell of a lot better than I do. I wish I had just this much of your knowledge. So we're just going to kind of jump in and see where the conversation takes us. So let's talk about the state of software and cloud, right? It's been this big thematic investment for the past 4 or 5 years. You know, I know that accelerated during COVID, you know, where you had the digital transformation, a lot of companies moving to the cloud. Talk to us about, you know, what's going on right now. Where's your focus on cloud, and what stocks do you think are the most compelling right now?
Yeah, no, thanks, Jonah. It's great to have a chance to get caught up. So I think if we kind of back up and, over the last couple of years, as you said, we've seen this investment by large enterprises and this kind of secular move into, call it digital transformation, cloud migration. And really, that's foundationally driven by the need for enterprises to look for opportunities to automate more processes, to find efficiencies, to leverage software to lower costs and improve customer service. And I think even without COVID, those themes were important and continued to be important. But what we saw, and it's becoming clear now from COVID in 2020 and 2021, was really two things. One, that because of work from home and lockdowns, if you will, there was a acceleration of the need for those kinds of solutions, both around, call it digital transformation, and then just moving more and more operations to the cloud. So that happened, and then that was added to that was obviously low cost of money, and so both enterprises and a whole slew of new startups were able to enter the space, and drive up a lot of investment in cloud and software infrastructure, more generally. And when I say software infrastructure, that's the services that enable the delivery of content and business over the internet.
Like a Cloudflare?
Yeah, and examples of that would be like Cloudflare and content delivery, or a Datadog and observability, or even data itself, whether that's transactional databases like MongoDB or Snowflake. Confluent for moving data around, and then of course there's enterprise security, more kind of as a result of work from home and the need to move enterprise kind of operations and employees onto the internet versus relying on them being in the office. But what we saw is a lot of these companies were heavily investing in those themes over 2020, 2021, and they were doing so, let's say, without a lot of focus on cost. So there was more of an emphasis on growth and feature delivery and solution delivery at speed, and not as much of a requirement to loop back and and kind of look for opportunities to reduce costs or optimize. And in any technology development, there's always kind of this thing we call technical debt, which is where you build an application and then you identify maybe database queries that aren't as efficient as they could be, or utilization of certain, software tiers that could be done more efficiently. And a lot of and there's oftentimes teams will track that kind of work, but when there's a push to keep releasing quickly and a focus on growth, that kind of work gets deprioritized. Well, now what we saw or more recently in 2022, certainly as macro slowed down, interest rates went up, that free money wasn't as available. Enterprises felt pressure. They weren't as willing to invest in these digital transformation projects. And what they shifted a lot of their focus to was optimization. So that debt that they had built up over time, now they said, hey, now we have some cycles to loop back and find some efficiencies in our database queries. Look at maybe server tiers that could be slimmed down. Maybe we can find better ways to use our observability solutions. And so what I think that's created, and the hyperscaler earnings kind of reflected this, but also those software infrastructure names I mentioned as well, where they're now faced with this headwind, at least have been over the last 6 to 9 months, certainly most of 2022, and probably going forward for maybe first half of this year, where you're literally seeing some companies are able to either pause their spend or reduce the utilization, because a lot of these services are on consumption models, reduce the utilization. So that's creating a headwind to the increase in their spend, where their spend either, like I said, pauses or certainly reduces significantly from the 30 to 40% year over year growth we were seeing over 2020 and 2021 to more of a flat growth. But what's interesting, I think, is okay. So if we think about that's the state of things now, if we look forward, I think there's two factors that could make things interesting going into 2024. One is,
and when you look forward, you kind of have to assume, okay, looking forward, do we have a recession? Is it mild? Right? I mean, what sort of macro backdrop are you assuming?
Yeah. So I mean, macro is obviously.
And I don't know either. I mean, right? I mean,
yeah. So I think in some ways I say, okay, macro will be macro. I don't necessarily plan for macro, but at the same time, I think that it's important to acknowledge probably. So I think we could recognize that 2022 was very disruptive from a macro point of view. And, if we want to focus on inflation and Fed's response through interest rates hikes, that was obviously the fastest interest rate hikes in history.
Yep.
And I feel like, and I'm not a macro expert, but I feel like we're getting over the hump, so to speak. And I think that what was really disruptive to valuations and to enterprise spend in general was just the rate of change. And having been on myself on the budget side of things within enterprises, planning, IT budgets for large organizations, I know that fear of change at a macro level is often causes enterprises to pull back. But I think that if we look forward, I don't necessarily know exactly where inflation and interest rates are going, but I think that rate of change is going to slow down. So, inflation isn't going to continue spiking up the way it was. I don't think interest rates will, increase another 5% or 6% like they did over the last year. So maybe we get another hike or two. Maybe, inflation is a little, let's say, higher for longer. I think that if things at least calm down and that rate of change slows down, then that'll allow enterprises to feel more comfortable investing. Because at the end of the day, software is a competitive differentiator. As soon as one consumer company has a service that is digitally driven and improves the customer experience or drives lower costs, then all the companies in an industry will do it. And that's generally driven by software. So I don't think that software investment will go away. But what I think that is the macro stabilizes at least, and I'm not necessarily even assuming that it's going to improve, but at least if it stabilizes, I think enterprises will return to that investment. I think that the other thing that will happen is that optimization I talked about, all that, call it technical debt, or as I like to refer to it as optimization debt, that's getting paid off. And ordinarily, engineering teams will front load that kind of work, meaning they will look for the areas, the optimization that have the most impact in terms of, reducing their bill, reducing their consumption. And I think that a lot of that was front loaded, and we probably saw that in Q4 of 2022. We'll probably still see it a bit in Q1 and Q2, but I think that that's going to taper off. So where that created a large headwind and even kind of a reduction in spend in some areas with these enterprise IT budgets, as that optimization kind of works itself through, I think those enterprise IT budgets kind of return to a normal level. And then the other things we've seen is that with all those companies that I mentioned, and even the hyperscalers kind of reflect this, but they don't report on customer counts, is all of those are still getting new customers. So customer additions haven't gone to zero with these software infrastructure companies. In fact, if you look at Datadog, Snowflake, MongoDB, Cloudflare, all of the ones I named, because they report customer counts, or actually their customer additions are tracking roughly at the same rate as they were during COVID. It's just that the expansion of the spend has slowed down due to those headwinds that I mentioned. So I think there is the opportunity that as the optimization slow down, the IT budgets of the large existing enterprise kind of spenders stabilizes, that will at least start increasing the spend and i.e. revenue with these companies. Plus, you've got all the new customers, all the enterprises that are brand new in their digital transformation starting to then ramp up their spend. I think that it provides what could be an interesting setup going into 2024, and everybody likes a revenue reacceleration story. I don't think we're going to get back to those crazy like 50, 60, 70% year over year revenue growth that we saw in 2020 and 2021, but I'd be happy, with 40% revenue growth, let's say, for a couple of years for those companies that I mentioned. And I think that that's possible. They haven't, none of them are that large where, a 30 to 40% per year revenue growth is out of the question. And then I think the other interesting thing is all of those companies, including the hyperscalers, have been optimizing their own operations. So you've seen either layoffs or you've seen talk about slowing down in hiring with a number of these companies. And we see the data because most of them report their employee counts. They're hiring to slow down, and all of them have shifted now to being profitable. So where guys maybe not guys like you and I, but certainly more traditional investors have complained about the fact that, the Cloudflares and the MongoDBs and, even Snowflake, all of these companies weren't necessarily profitable 2 or 3 years ago. Now they've got positive free cash flow, which is an interesting change. And that's probably going to become even more positive over the next year or two. So
you think we'll see more layoffs or just stagnant hiring?
I don't think we'll see. Well, I mean, if macro certainly gets a lot worse, I don't think we'll see more layoffs. I think the reason we saw layoffs over the last 6 months is because those companies essentially, well, I wouldn't say overhired, but they were.
Meta had something like 85 or 90,000 employees at their peak. I mean, that was just that's ridiculous. Yeah. So you could say they overhired. Let me say they optimistically hired, and you hear even as Meta described it, or Stripe, or Shopify, they hired expecting that rate of growth that they experienced during COVID to continue. Right. And as it started to slow down, it became clear that they had overhired. Now they probably say they overhired. Back then they said they were hiring for growth. But regardless, I think that they're more in tune now going forward with a more realistic view of what their staffing needs are, or their, what their expense ramp should be. So I don't think they'll get ahead of themselves again. And I would be surprised if there were another round of layoffs, but we probably won't see the headcount growth that we saw in the past, where, some of these companies were doubling their headcount in 2 years. So we probably won't see that. What's a good example of two companies that compete against each other in the same sector or niche, and one has kind of like flat pricing and one has consumption pricing?
Oh, interesting. Well, by flat pricing, you mean like a subscription type pricing?
Yeah. Or they do it by, I mean, because is Cloudflare, are they flat or are they consumption?
They no, they're call it a subscription model, in that they charge what's interesting is they charge a fee for these services that's negotiated. That's not necessarily, some of it is usage, it's kind of mixed, some of it is usage based, some of it is flat. So like their zero trust solutions are subscription based. They're like their workers and their new data storage tier with R2 is consumption based, so there's kind of a mix of both. But I think what you're getting at is, is there
Like curious which model is more resilient, I guess.
Well, yeah, exactly. I think that's
Slowdown.
I think that's what you're kind of getting at. So I think the subscription model is more resilient in the in the near term, meaning that it's more protected in the short term from a market slowdown, where obviously consumption model like Snowflake is very much consumption model. MongoDB is, Datadog has some consumption, but the majority is subscription. Where it's when companies are optimizing their spend, a consumption model is impacted much more quickly. And we see this with the hyperscalers too, because they're all consumption model. And so it is much like the reduction in spend is apparent, quarter over quarter, right? And so you can very quickly see that reduction as companies are cutting back, versus if it's a subscription or a longer term contract, like some of the security vendors have, like a Zscaler or a CrowdStrike. They're going to be a little more insulated, but I think that subscription models still get affected. It just takes longer for that to manifest, and then the other side of the sword, of course, is the consumption model gets hit more quickly or more acutely, but then as things improve, then they would reflect that sooner than a subscription model as well. So I guess if you were trying to play it from an investment point of view, it's probably safer as consumption is going down to be in companies with subscription models. And then as things are improving, obviously you shift to a consumption model. That's what you and I saw a little bit in even 2020 when like Fastly was a consumption.
Exactly. That's the one that I was getting
through
at,
the roof, right?
Fastly versus Cloudflare. I mean, they were
that's a good example, actually.
Going head to head in 2020, and Fastly looked like Fastly was taking a lead because they had, the Shopifys, the Spotifys, the TikToks, and their consumption or usage-based model. And then, once TikTok left, it was just like the whole thing fell apart.
And that's where
Cloudflare is really eating their lunch.
Yeah, well, Cloudflare didn't have, as much of and I think that was a lot of that was overage fees too, but it was consumption regardless. Cloudflare didn't show as much of that immediate growth because a lot of their customers for those types of services are in contracts, where either they're paying a fixed rate for, and I wouldn't say unlimited, but certainly a large variance in the amount of usage. Or they're paying for a full year of something, where then as usage shoots up, the customers were more insulated from that. So, but we saw the downside, which is customers didn't necessarily like to see their bills shoot up, and so I think that hurt Fastly.
Right. For sure.
As we got into the following year.
The fact that the startup world has taken a hit. There are. Not just the Silicon Valley Bank thing, but I think just in general, VC funding is probably down dramatically over the last year. You haven't seen a lot of big IPOs. Has that hit some of the software stocks? Meaning, I think a lot of these VC-backed companies were also customers of Snowflake, Datadog, because they themselves were growing so rapidly. They needed these services. Do you think that's also hurt the cloud software stocks?
No, it definitely has, I think. And I think that's a great point to bring up. I mean, and we saw that starting in 2022, where, a lot of these, call it digital natives, the Instacarts, the Coinbases, who, those are larger companies. And of course, there are a whole long tail of smaller ones that were, non-public VC, private and clearly VC backed or funded because they weren't profitable, so they're getting outside funding. So as that, I think COVID driven growth in the case of, let's say, Coinbase and Instacart slowed down, that impacted software infrastructure utilization. But then, yes, the flow of VC money into new startups, which most of these new startups are building an experience on the internet. That then is as that VC investment slows down, that's creating a headwind as well. I think that created more of a headwind in 2020. I think SVB is interesting in that could create a new headwind. I think the good news for a lot of these companies is that they also, over the last year, have been focusing more of their revenue on more established, like larger customers, enterprise or whatever you call it, Global 2000, Fortune 500, where an increasingly large amount of their revenue is coming from certainly large spending customers, which you could argue could still be some of those VC backed, but it is also shifting more towards the Global 2000, where you see 50% or more of their revenue coming from like Global 2000 versus a lot of little startups. But I think there'll still be some noise potentially as that VC money at least hasn't picked back up.
So something like cybersecurity is still, a pretty significant secular growth story, but there's so many different players in cybersecurity, right? You have CrowdStrike, Zscaler, SentinelOne, those are kind of like the three new kids on the block. And then you have what I think are like the older players, Palo Alto, Fortinet. Like how should we think about them?
It's interesting.
If you want exposure to cybersecurity, like how do you know where to start? I mean, if you're a little bit more risky investor, do you go with the Zscalers and SentinelOnes because they're growing faster, or is there more to it than that?
Well, I think that's a good way to play it. So I think there's two sides. So I think, really several things to talk about. One, cybersecurity is, as you said, it's a secular trend or theme. It's not going away. I actually, during like the heyday of software infrastructure growth, I wasn't as hot on cybersecurity just because I feel like, it's not necessarily a growth area. It's, could be a little bit commoditized, but I've kind of come around to the acknowledgement that cybersecurity, I think, will continue to get investment. I think that's also driven by the fact that most enterprises now have moved cybersecurity functions into their own department. So they're led by this, C-level individual who's the chief security officer who gets their own budget. I assume work from home makes cybersecurity even more important, right? Yeah, work from home makes it more important. The threat is not going away. You've got these state actors, whether you're talking about Russia or Iran and China, et cetera, who are still actively doing bad things. So I think cybersecurity and while we've heard about cybersecurity for a couple of years, most enterprises are still behind the curve, particularly as it relates to, responding to work from home, moving their employees onto the internet, making it easier for them to connect to resources. So I think cybersecurity has
all these companies are moving to the cloud, right? They're not using like on-premise as much anymore.
Correct. Well, all that and there is a huge long tail of on-premise, infrastructure and equipment that needs to get upgraded. And I think that's going to be a cycle that lasts for probably 5 or 10 more years. So if you agree that the backdrop is still there, that the secular trend is still strong, I think that's in favor of these companies. Two, as we were talking about with VC drying up, while that has hurt the creation of new demand because there's not new customers or companies that need to be secured. The flip side is there's less competition. So I think that the VC drying up has actually culled the competition a little bit. Because if you'll remember a year or two ago, every time you turned around, there was some new cybersecurity startup. It was 3 IPOs a week. Yeah, exactly. So I think that the VC funding drying up a little bit will benefit the incumbents, meaning that they'll have the opportunity to there's just when they go to sell an enterprise deal, there's just fewer competitors in the space. So I think that will be a benefit. So then you've got in this mode of kind of cost reduction or pressure on IT budgets, that generally creates this effect that everyone loosely calls consolidation. So it's the idea that, hey, if I'm a CTO or CISO and I have a bunch of individual vendors selling me security solutions or, software infrastructure, anything on the stack. One way that I can reduce my budget is to consolidate those solutions, those use cases onto fewer vendors, because generally I'm going to get some sort of volume discount, if I'm, moving all of my security solutions to a larger provider who, has a lot of touch points. Even if their solutions aren't necessarily best of breed, I could probably live with that because it's more important for me right now to reduce costs. And certainly those vendors, who have a platform that covers a lot of different solutions will make the argument that their solutions are just.
Who do you have in mind when you say that?
So
Cisco's, like those guys?
So that's the setup to say that, let's say, a Palo Alto is very well positioned in this environment because they cover endpoints, they cover network security, SASE, they cover the kind of data, the data processing, the analytics side. So they've got solutions in all of those areas, which would encourage a CISO to engage with them versus using a point solution for each of those. So I think one is consolidation is a thematic. So you've got, I think Palo Alto is a beneficiary of that. I think Fortinet is. CrowdStrike, a little bit in that they just have so many different modules, but they don't really offer the SASE, the network security solution. And then you've got kind of the leaders in, let's say, a subset. So then, well, if I need endpoint and I want best of breed, well, then CrowdStrike, is clearly the leader. If I want network security or SASE for my employees who are working from home, and I want to get them onto onto the network securely and pass their traffic to whatever enterprise applications they're trying to access, then Zscaler is well positioned for that. And so you've got those companies, I think, are still safe if the buyer is looking for best of breed, and is comfortable with the idea of having, let's say, 3 or 4 vendors versus like putting everything under the Palo Alto umbrella. And then you've got the smaller players who, are become a little more niche or are more of the upstarts. Let's say like a SentinelOne, plays heavily in the endpoint space and now has some solutions for cloud security and for the analytics. There's where
does SentinelOne compete more against Zscaler or CrowdStrike?
CrowdStrike.
Okay.
Yeah. So I would say in terms of the competition side, you've got Palo competes with everybody. Then you'd have like CrowdStrike and SentinelOne competing on the endpoint and kind of the data platform side. Then you've got Zscaler and Cloudflare being kind of the new entrant there, competing in the SASE or the network security side. And then you kind of got the old school data analytics, which is where you've got like a Splunk. Datadog has gotten into that. Elastic does that, where they take they ingest the data from all of the different sources and then try and identify threats through data analytics. So Palo does all those things, but kind of going back to your point, so CrowdStrike and Sentinel compete on the endpoint side of things. Zscaler, Cloudflare, Netscope compete on the network security side. So Sentinel, I think, is interesting in that, one, they're considered, in some circles, to have a more robust or more effective endpoint solution, primarily because they're newer and also because of the way that they kind of process the data and they are able to engage more AI or make it more automated. But they aren't necessarily recognized as the leader in the space. And if, in this environment, CISOs are more want to kind of go with the safer choice, CrowdStrike is I think the beneficiary of that. But SentinelOne stock has been beaten down a lot. So
it's starting to look attractive at these prices.
Yeah, exactly. So that becomes a little bit of the risk reward type discussion. So I could see SentinelOne stock more likely to double in the next 2 years than like a CrowdStrike, but CrowdStrike is probably a safer play for if you're looking for, at the high end, like a 30 to 40%, recovery in the stock price, so to speak.
Now, I don't know if you think about this stuff, but do you think we'll see, and you can expand beyond just cybersecurity to answer this question. Do you think we're going to see more M&A in software cloud? We've seen some of these private equity companies come in and take out some software companies, but we really haven't seen other software companies take out each other. We really haven't seen any M&A in the space in 2 years, none that really come to mind, at least. Do you think that will be a theme at all?
I think it's an interesting question. So I think there's going to be a couple of things that happen. One, there's clearly, especially in this environment where there's a lot of pressure, you've got a couple of players in each category that are publicly traded that are just not growing anymore. They're being challenged. That might then, and we've seen some in SaaS where then the PE firm comes in and buys them because their multiple has gone below 5 or something.
Right. No, for real. I mean, you've seen someone.
So I think we could see a little bit of that. So like maybe, let's say observability, like New Relic has been doing worse than like Dynatrace and Datadog. Maybe do we see a New Relic get purchased by a PE firm, and taken like private, and then maybe whatever they do,
fixed up,
take them public, fixed
put
up,
some lipstick on it, and then take it public in 3 or 4 years.
Yeah. So you could see that. I mean, you could argue Fastly was probably a candidate for that. And I mean, they've turned it around a little bit with the new CEO, but they were certainly headed towards that kind of treatment. So I could see that in each of these categories, you could see the potential for a little bit of that. If one of the companies in that category just isn't growing as fast, or if they have a surprise bad quarter and their valuation goes way down, they could get acquired either by a PE firm, or the other is you've got these large traditional incumbent technology companies, maybe not the hyperscalers, but like you were talking about earlier, like a Cisco or
Oracle, IBM.
Oracle or those, IBM, who then see a one of these publicly traded companies, but with a low valuation, but that has a capability that they lack, that they wouldn't mind adding on, and potentially then cross-selling and and engaging with a better sales team. So I think we could see some of that as well. With the leaders in each of the categories, I don't see obviously a Snowflake or a Datadog or a Cloudflare getting acquired, but they've been doing some acquisitions. Now those are mostly for call it tuck-in for employees, for a specific capability. I mean, almost all of those acquisitions we've seen from the leading software infrastructure companies have had no revenue. They're like companies who are
usually
like
under $1 billion.
It's just for staff. But I mean, if you and I will recall, just a couple of years ago, there were a lot of these acquisitions that were happening that were accretive to revenue. I mean, look at like what Twilio did. I mean, they bought SendGrid that had revenue. They bought Segment that had revenue. And we've kind of seen that. I mean, Fastly bought a security company that had revenue. So but we haven't.
Who came in?
That's a good point.
Who was the? I remember when Fastly bought. Was it Signal Sciences? Yes. I was thinking that the CEO of Signal Sciences should be the guy running Fastly, but Fastly took another 2 years to get rid of their guy. Who's the new CEO and where did he come from?
Where did he came from? Was it Cisco?
Okay.
Yeah, I want to say Cisco.
Because there was rumors a couple of years ago that Fastly was going to get acquired. I forget if it was by Cisco or Oracle.
Yeah, that was Cisco. Also an outside chance with Google Cloud Platform, but Cisco was kind of the one who seemed most interested. No, and that's right. The new CEO did come from Cisco, and that's why some people, still speculate that Fastly might eventually get acquired.
by Cisco. Fastly stock's actually been doing all right recently.
Yeah, no, he's done a good job. I think just focusing them on what they do well, and just delivering and being disciplined and keeping costs under control. And and I mean their revenues, they're doing maybe 20% year over year, but they're on a path to profitability. And I mean the valuation came down so low that it was actually starting to look attractive.
Some of these stocks were getting priced like they were going out of business. Fastly was probably one of them. I mean, I think the stock got down into the single digits.
Yeah. So
What's a software name, cloud name, cybersecurity name that no one really ever talks about, but you're watching, that you think there's something interesting there?
I think, well, I wouldn't say no one ever talks about, but I think there are a couple that have fallen off the radar that I think have become interesting because their valuations have come down and because of the opportunity going forward. So a company that I'm starting to look more closely at, and I just opened a small position in, is Confluent. So Confluent,
that's my next deep dive write-up. So
no, I think, in Confluent, as you'll recall, a year or two ago was hot. They had a high valuation, they were growing like crazy, and then they started to slow down like the rest of these. And and they've kind of fallen off the radar. Their PDS ratios dropped below 10. Maybe it's right around 10, but they're still putting out reasonable growth targets. So for this year, their initial preliminary guide was 30%, revenue growth. And the nice thing is
probably conservative.
Yeah, and that's probably conservative. Their cloud solution, Confluent Cloud, is growing rapidly. It still did 100% year over year growth in the last quarter. I mean, we would expect that to come down, but their target is for it to be 50% of revenue by the end of this year. They did a little layoff, which the market interpreted badly, but I actually think that was.
It's funny. Prudent. It's like when a company does a layoff, sometimes the market's like yay and sends the stock 5 or 10% higher. Yeah. Sometimes it's 5 or 10% lower. It just kind of depends on the mood of the market.
Yeah, they did an 8% workforce layoff, but I think that's okay because you could argue they probably, like other companies, overhired during the period. But what the result is now they're projecting going from negative 20% operating margin in Q4 of 2022 to break even by Q4 of 2023. So I think going into next year, it could be interesting where you have a company that will do 30% plus revenue growth this year. Analysts are projecting like 26% for next year. So that could actually go up as well. So a company over 2 years doing 30% plus revenue growth that then inflects to, positive operating margin and free cash flow. I think it could be an interesting setup. It's still at a reasonable valuation now. So I think that there are.
And that's the kind of company that could get acquired, right? I mean, it's on the smaller side, still has growth. It could be that could be a nice tuck-in acquisition for somebody.
Yeah, exactly. So I think that it plus you've got potential secular tailwinds reemerging, not just in general with infrastructure, but there's a lot of emphasis on data right now, as as it relates to this kind of AI, call it tidal wave. but what an AI, I think
I can't believe we went 40 minutes without talking about AI.
I know. I try to avoid the hype, but for me, what I'm trying to parse out with AI is, well, what would be the benefits to software infrastructure companies to come, my segment. And my initial thesis is that AI is going to drive more investment in software because software just will generate better capabilities. I think of any SaaS application that an enterprise uses, it's going to be more powerful, more capable, and ultimately more used. And you also think about like some of the consumer internet services as well. So you got ChatGPT with their plugins. Well, at the end of the day, it's going to drive, in theory, more business to travel companies or to food delivery companies because it's just easier for you or I to ask ChatGPT to plan a trip for us to the Bahamas, and it goes off and provides all that, does all this research on prices of flights and such, which would generate more usage of those that cloud infrastructure. So my general thesis on AI is that it is going to increase the use of software. I think the other dirty little secret is if indeed worker productivity goes up, particularly for, call it white collar or information processing type jobs, there are a lot of those at enterprises. If they need fewer of those people, where's that money going to go? That money can go right back into software that's more, more powerful, more capable. So where maybe in the past, a typical department, whether it's an IT department or finance or HR or sales even, where maybe 80%, 90% of their costs go to headcount, if they don't need as many people to do the job, then you could see that ratio being like 50% people, 50% software. Well, what does that mean for, the opportunity for software spend? So that's my general thesis. Looping back on Confluent and data, another obviously key ingredient to enabling all these AI experiences is data. And a lot of enterprises still are challenged in making full use of the data that they have. It's in these silos, it's in an unstructured format, it's not readily accessible. So we could see a lot of, the Global 2000 investing in improving their data infrastructure to make better use of AI. So what does that mean? Well, transactional databases could get more usage, like Mongo's, data warehouses and large-scale data processing systems like Snowflake and Databricks could get more utilization, and they'll need to move their data around. So Confluent could see a tailwind from that. So in addition to kind of what you were getting at earlier around, well, what are some companies that have maybe fallen off the radar that as things pick back up could get some benefit? I think a Confluent might get the double benefit of not just a pickup and spend after they've been forgotten, but then also riding this AI wave. It's more, the second derivative of the AI wave, they're not obviously selling chips like NVIDIA, but I'm trying to more broadly think about, well, who is like secondarily going to benefit, from just more usage of AI. And so I think that like data curation and moving data, making data more accessible could be, an outcome.
I'm trying to think how I want to ask this next question. And in my head, I'm thinking, do I want to say, okay, pretend all of your stocks drop 20%, which one would you add to first? Or you could only own 2 or 3 companies over the next 2 or 3 years. Which 2 or 3 companies would they be?
No, that's a good question. I think, the way I think about that over the let's call it the long term, if you had to just freeze your portfolio for 5 years, what would you do? I still come back to competitive moats. Like, what companies do I think have the potential for durable revenue growth? Durable meaning just consistent. And how do you ensure that a company has durable growth? It's through competitive advantage or having a competitive moat. So I look for companies that have some sort of, advantage, or i.e. moat. And those are the companies I like to stay invested in. So, while it's and these tend to be the expensive ones, but
right.
While it is expensive, I like Cloudflare. I think that they have a huge competitive moat, primarily around their architecture and the way that they've set up, all of their data centers across the globe. And that, more importantly, the way that they developed the compute, the processing within those data centers, where their applications, their software, every service that they offer runs on the same software on every server in every data center. So they've got this huge, I think, advantage in terms of the ability to launch new software services quickly and roll those out at very low cost. And I think that they're going to undercut a lot of kind of incumbents in different areas, and we're even seeing this in theory with Cloudflare versus Zscaler, where I think they can offer.
Cloudflare is pushing into cybersecurity, aren't they?
Yeah, they are, and I think that because of the way that their network is deployed, I think they have a huge advantage there. Plus, they have millions of free users. They provide hosting services for 20% of the the websites on the internet. So you think about what kind of advantage does that give them from a data collection point of view. I think it's huge. So I think that's one. I think Snowflake still has competitive advantages more around their data sharing and the network of their industry networks that they're building. Where I think that while analytics is important and machine learning and all of that, I think that what is companies or enterprises are realizing is there's value in combining their data with other partners within their industry. So where you see Snowflake setting up these industry, call it offerings around finance, around media and advertising, around healthcare, that is all grounded in the ability to share data, facilitate secure data sharing with governance and these things called clean rooms, and then ultimately allowing applications to be built on top of that data within Snowflake. So this idea of that overreaching data cloud, I think, actually could become possible, and that creates network effects. And of course, network effects generate, competitive advantage. So I think Snowflake's well positioned. And I still like Datadog. Now, the reason I like Datadog is not because of their observability solution, but because of their product development funnel, the speed at which they can build and launch new products, and the efficiency with which they do that. I mean, and I've shared this before, but Datadog is the only company in my coverage space who can spend more on R&D than on sales and marketing. So
Wow.
that is a pretty significant advantage. So if you look at every other company,
do they spend more on R&D than sales and marketing?
Yes, it's
holy shit. Because I mean, that's sales and marketing is usually a massive expense for these companies.
Yeah. So normally the ratio of sales and marketing, you look at it GAAP or non-GAAP, is 1.5 to 1. So they'll say, in round numbers, they'll spend 150 million a year on sales and marketing and 100 million a year on R&D. And some are worse. Some have to spend, 2x more on sales and marketing.
Yeah, I bet SentinelOne is probably closer to 2 or 2.5.
Yeah, exactly. And surprisingly, Zscaler's around 3. Now they think they have some efficiencies in how they do an R&D, but you look at that metric, Datadog is actually in Q4 it was 0.68, meaning that they were able to spend it was like 140 million in round numbers, 140 million on R&D versus 100 million on sales and marketing. So they're spending more on R&D than sales and marketing by a large factor. So
the question is, are they spending too much on R&D or not enough on sales and marketing?
Well, I think no, that's the good counter way to do it. I mean, but you look at their growth, at least in the past, that hasn't been a hindrance. I think that what it recognizes is the fact that they have a very efficient go-to-market where the majority of their revenue comes from expansion from existing customers, and that sales process is efficient because turning on another module is very easy for a customer to do, and they've been thoughtful about how to expand from their core in the 3 pillars of observability, infrastructure, APM, and logs, into all of these other aspects of observability. But now they're moving into developer operations. They've got some basic security offerings. So I just think that frictionless expansion motion is going to continue, and it's all grounded in the ability to build these best of breed products because they're investing so heavily in R&D.
Last question I'll ask before we get out of here. Any private companies you're looking at? It feels like we haven't had a software or cloud IPO in 2 years. And I don't know if we're going to get one anytime soon, but are there any companies that you would like to see come public? I know Databricks has been mentioned before.
I think Databricks would be really interesting, and I would invest in Databricks if they came public. I mean, obviously,
are they similar to Snowflake?
Yeah, they're similar but different. I mean, I think that they both 10 years out have the same vision, which is they want to be the common data plane for all analytics and machine learning and anything data related for the enterprise. But they're coming at it from 2 sides. Snowflake is more from the traditional data warehouse analytics, expanding into machine learning and and other types of AI driven workloads. Whereas Databricks, being built on Spark, was always more geared towards machine learning jobs and and kind of the not as much the traditional data warehouse. But they're converging towards the same point. I prefer Snowflake at this point only because that's what I can invest in. But I think Databricks would offer an interesting alternative to play the general thesis around just the growth of data and the importance of it. And I think they're both well positioned, both for all this AI stuff we're talking about, but just the increasing reliance of enterprises on data. And I mean, the elasticity of spend in that space is amazing. I mean, Snowflake talks about $100 million customers. It's just crazy. And I think Databricks probably has the same potential.
What's their goal? Snowflake, is it 10 billion in revenue by end of the decade? Is that their number?
Right? It's 10 billion in product revenue by FY 2029. So
okay,
that would be calendar year 2028.
And I think that's, what is that, like a 25% compounded growth rate?
Yeah. Compounded. It's like 20, between 25 and 30.
Okay.
Like 28 or something. So they've got that target out there with, and that along with that comes 20% plus operating margin and free cash flow margin. So if they achieve that, or obviously, beat that, then that becomes very interesting. There's a couple other companies that have thrown out those big targets. I mean, you've got Cloudflare saying they're going to do $5 billion in revenue, within 5 years of Q3 of 2022. So that would be Q3 of 2027. They said they'll have a run rate of $5 billion, which would be $1.25 billion in quarterly revenue in Q3 of 2027, which would be essentially 5x from where it was in Q3 of 2022. So that's interesting. And that compounded is, I think it was 38% annual, which is
that got me some tickles.
Yeah, no kidding. I mean, especially in this environment, and to hold it for that long. But you even have CrowdStrike. What did they throw out? I think they said $5 billion in revenue, but in like 2 years. So there's a couple of companies that are still, willing to support these kind of audacious growth targets over the next, over the long period. And I think that if anything, by throwing down the gauntlet, you would imagine that, particularly for those founder-led companies, that they're going to make sure it happens. Because
for sure.
Good God,
I mean,
George
I
Kurtz or Prince, I don't think they'd want to admit failure. And Frank Slootman.
Do you like the fact that, I mean, most of the companies that you're invested in right now are probably still led by the founders, right?
Yes.
I mean,
I do like that.
Yeah. I mean, Slootman's not the founder of Snowflake, but he's almost like an honorary founder.
Yeah, I think that's a good way to put it. Yes, I think founder-led is ideal if the founder has the skills to do it. You look at Twilio, like Jeff Lawson's a great developer, great visionary. Has he been great at execution? Maybe not so much. There's probably some blind spots for him. But then you look at
he got lucky with the pandemic, like Twilio and their API. I mean, all of their customers, like, the Ubers, the DoorDashes. I mean, those guys business was booming during the pandemic.
Yeah.
So they crushed it.
Yeah, you could say the same about, let's say, Todd McKinnon from OKTA.
Yeah.
Same thing. Like, maybe he got a little over his skis in terms of he's a great technologist, good visionary, right place, right time. Is he the best leader? I don't know. Remains to be seen. Do you think Okta's in trouble? Are there too many other companies that are just going to be getting into their space?
I actually think Okta will be okay. I mean, that's another one. If you could put in the what we were talking about earlier with Confluent, like a company that might come back. I guess in some ways they already have a bit. Like they had a good quarter, and their stocks recovered this year. I think I mean, they're still really the leader in identity. Especially acquiring Auth0, whether you like the terms of it or not. That was a good consolidation or acquiring what would have been their biggest competitor. I actually think that they're well positioned in the space. The only other competitor there is Microsoft, but just like in endpoint, I think most technologists are gonna shy away from a a Microsoft security solution. I mean, granted, they can do well in bundling, but I also think there's always I thought more companies Microsoft.
I thought more of these cloud companies were trying to get into identity, but not so much.
No, not so much. I mean, I mean, in terms of like on a security base, you've got some companies who are getting into identity security management, but more using identity as an input, like CrowdStrike does, as an input as a signal towards a potential breach, but they aren't offering the service of authenticating users either on on an enterprise application or on a website.
That's gotcha.
Okta's still the primary provider of that. So Okta may be well positioned. I don't think they have as many tailwinds necessarily as Confluent, but they're certainly. I think that.
Work from home is not going away, and work from home was probably good for Okta, right?
Yeah. Work from home was good for Okta and use of
more
internet
cloud.
applications. Yeah, more cloud because people you have to log into most of these websites, and a lot of those, a lot of that authorization is powered by Auth0 still. So I think that as they get through the integration with Auth0 and they had kind of some missteps there, they actually could kind of come out of it with a pretty solid solution that's somewhat, unique in their category. They're not really seeing a lot of competitive infringement. It's kind of the tailwinds of just general digital transformation growth.
Yeah, because when you think when I think about software or cloud or cybersecurity, I can rattle off 10 or 15 companies in each. Within an identity, like Ping got taken out, right? They got acquired.
Yeah, Ping got taken out, and then it's Microsoft and Okta. That's really your big players. Yeah.
Who bought Ping? Was that a private equity deal?
Yeah, I think it was. No, it was. One of the private equity firms.
Thoma Bravo, or
I
forget. Yeah, it was like 2 or 3 that have been doing all the deals.
Yeah.
Exactly. Peter, where can we find you?
Yeah. So, as you said, I run a blog called Software Stack Investing. You can also follow me on Twitter @Stack Investing. So those would be the 2 logical entry points, and I focus primarily on software infrastructure, kind of stayed narrow to that category, and, cover a lot of the names we discussed, and intend to continue to do that going forward. But
if I ever decide to torture myself again and do another conference, I'm sure you'll be there too.
Of course. I wouldn't miss it. It's always fun.
Last time I saw you was in Vegas, you and Muji. So
that's right. Yeah.
Drinking those $20 drinks at the pool.
Exactly. Always look forward to those.
Well, thank you so much, Peter. Always great to catch up with you. I hope to talk to you again soon.
Okay. Take care, Jonah.
Have a good one, man. Appreciate your time.
Right.
Bye-bye.
Yep. Bye-bye.